growing legacies. Co-presented by Century Ply, Aag se Bachai. Co-presented by Macho Hint, Fashion Bade Aaram Se. Co-powered by Samsonite, tested like Samsonite. Indian Oil, Pehle Indian, Phir Oil. Nippon India Mutual Fund.
Hello and welcome. The last session at the World Economic Forum in Davos is a global economic outlook. And what I thought we'd do over the next several minutes here at the Business Today Market Summit is to do an India economic outlook with some very sharp economic minds. And the global consensus seems to be that the world could potentially be able to avoid a hard landing in a deep recession and instead get away with a softer landing and slowing growth. What does that mean in the context of the India growth story? We have a big budget coming up in just a few days from now. Crucial also because this is arguably the last budget before the election cycle kicks in. So what can Finance Minister Nirmala Sitharaman and the Modi government do to capitalize on the unique global headwinds and tailwinds that are playing out at this moment? So to talk about this at the Business Today Market Today Summit, I want to introduce our panel of guests, starting with Pranjal Bhandari, Chief Economist, India at HSBC. Flanking her, Samiran Chakrabarti, Chief Economist, India at Citibank, and Soumyakanti Ghosh, Group Chief Economic Advisor at the State Bank of India. So let me start by asking Pranjal about what do you think Finance Minister Sitharaman can do at this moment to try and make most of the global tailwinds that seem to be blowing in India's favor?
Yeah, thank you very much. I think the best thing that can be done now is to keep the budget boring. And by boring, I mean keep it predictable, keep it credible, and just go on the path which you've promised. Now, we talk a lot about growth. But in a year like 2023, when there's a lot of uncertainty globally, I think the best thing that we can do in India is maintain macro stability. And macro stability means low inflation, fiscal consolidation, lower trade deficit than what we had last year. Because if the stage is set with macro stability, when the global economy turns and rises again in the next couple of quarters, hopefully, India will be ready for a takeoff. So I think the budget should be boring. It should basically focus more on macro stability rather than high growth. And from that perspective, I think the path is very clear. The finance minister has already spoken about a fiscal consolidation path, bringing down the fiscal deficit from 6.5% to 4.5% over the next 3 years. It should really, focus on that path. Of course, on the background, some changes can happen. For instance, improving the tax regime, and we can come back to that later, and also focusing on capex, which has been a thrust of the government, but mostly focusing on continuity rather than doing something dramatic and big bang.
Given the emphasis that we've seen on public spending and capital expenditure, do you see that continuing, or do you think it's reached a level where the government will need to start cutting back, Samiran, to some extent? What do you think can be done in this unique moment for India to try and step on the accelerator on economic growth?
Clearly, Rahul, I would say that investment. I think in the last year's budget, if you look at, this was the theme of the budget. We don't change themes every year. So there is a need to continue with that theme. And our sense is that not only in rupees trillion terms, but also as a percentage of GDP, there is a need to increase the public capex part. And increasingly what the central government is realizing is that it's only a limited areas where the central government can make a lot of capex. The power lies often with the state governments. So it's quite keen to deliver a larger amount of resources to the state governments to spend as well.
But when I speak to bureaucrats and ministers in the government, what I find is a growing sense of unstated frustration with the fact that when it comes to spending, the government is having to do the heavy lifting, and despite the deep and sharp reduction in corporate taxes, private investment isn't stepping up to the plate. And I think Nirmala Sitharaman has publicly spoken up about this a couple of times, nudging India Inc. to do more when it comes to investment. But that, for some reason, doesn't seem to be happening.
So I don't think there is any other option but to be patient. We have to understand that even pre-pandemic, India was going through pretty slow growth compared to what India's history has been. And the pandemic has obviously had almost 2 years of low growth. And now with this whole geopolitical uncertainties, it's difficult for private capex to immediately pick up, given the background that we have seen of last 5-6 years. But what we have to also keep in mind is that we are now reaching almost all the preconditions that are required for a private capex recovery. Look at corporate balance sheets. If you look at the financial system balance sheets, we haven't seen this kind of a balance sheet in almost a decade. So with the right kind of public capex and the policy thrust that is there towards manufacturing that this government has put forward, I think it's just a matter of time we will see a private capex recovery.
But Soumya Kanti Ghosh, this is something that the pundits have been saying for a long time. The capacity utilization is in the mid-70s. India is poised for a multi-year investment cycle, an investment cycle which so far hasn't kicked off in right earnest. Why? And do you think, like Samiran, that that's now finally about to change?
Yeah, thank you, Rahul. No, I think that last 2 years during the pandemic, if you look into the corporate balance sheet, they have significantly deleveraged. And so that's the first thing. So that's one of the preconditions for investment taking off. The second point to note is that if you actually look into the bank credit today, credit growth actually has continued to expand, even though there has been some moderation in the recent weeks. And a large part of this credit growth is not only the working capital requirement, which typically comes when the inflation is on the higher side, but also term loans and also some project announcements, as we are seeing in our books. So in my sense, I think there is evidence of an pickup in private investment activity. May not be that encompassing which all of us want it to happen. But at this point of time, if I look into the sectors which has deleveraged, like steel, like the metal sector, there is evidence of some amount of private investment picking up. But as we progress, and as basically as all of you also, as also there has been a lot of geopolitical conflict and uncertainty. So I think as the fog clears on the global economy also, I am sure that the investment is going to take off in a meaningful manner.
One of the Modi government's big thrust areas is to boost manufacturing and to take manufacturing to 25% of India's GDP. The needle hasn't moved much when it comes to the ratio of manufacturing as a percentage of GDP. In Vietnam, it has. And the big question in India and globally is, to what extent is India being able to benefit from a global realignment of supply chains, with many global corporations looking at an India plus one strategy? Is, Pranjal, in your view, India likely to be the prime beneficiary or just one of the multiple beneficiaries of this realignment?
Yeah, I think the good news is that India has gained a global market share in some high-tech sectors like mobile phones, drugs and pharma, automobile parts, and IT services. So that's the good news. But the problem is that we are actually losing global market share in trade in medium tech and low tech. For example, textiles, for example, small electronics, for example, agricultural products. I think our problem is why our manufacturing to GDP share is not rising dramatically, like, for example, Vietnam that you mentioned, is our industrial structure. We have too small firms which never grow over time. We call it the economic dwarfs. There can be different names to it. The problem is, if there are too small firms, they never gain economies of scale. They never become too efficient to sort of, really compete on a global level. And that is, I think, our real problem. And I think the big challenge is, how do you let small firms grow from small to medium to large, which is something in our country we don't see too much of.
I had a fascinating conversation with Raghuram Rajan, Pranjal, at the World Economic Forum about manufacturing and electronics. And his argument, and I'm curious to know what you think, is that PLIs is basically subsidy for capitalists, that there is very little value add happening, And while, of course, manufacturing is growing up, there's nothing to tom-tom about in terms of it being a big achievement for the government, that this is money that could be more wisely spent in things like higher education, produce more engineers. That has a higher ROI than just giving money through subsidies to corporates.
My sense is the PLI scheme is an experiment worth doing. We are trying to sort of, look into futuristic sectors and ensure that, India at least tries, right? And the other reason why I think we should do it is because it's actually not very costly. Barring the semiconductors, it's just over 2 trillion rupees spread over 5 to 6 years, which is our 1-year fertilizer subsidy bill. So it's not that much money. And even within that, the money was made possible by retiring some old export subsidy schemes. So there was smart thinking done there, and I think this is an experiment worth doing. But is this enough? Will this change India's future? Will it make it a big manufacturing hub? I don't think. I think a lot more needs to be done. Most importantly, I think overall business climate needs to improve in a way that small firms can grow and become large over time.
Samiran, especially on the issue of value add, opinion seems very divided amongst pundits on the efficacy of production-linked incentives. Are they working in your view, or are they not working in the way they should?
So Rahul, in a very broad sense, economists will always argue against subsidies. But having said that, the way to think about PLI, in my view, is that is it going to be enough to move companies who were thinking about investing in other geographies to come to India? Is that going to give that extra bit of leverage to us? And in that context, it's very important that the first few PLI schemes are success. Because I can tell you from my experience that a lot of foreign companies are thinking about India, but they are also fighting a perception battle that in the past, investing in India has been difficult. So if there are some companies which can show that, yes, India has changed and it's possible to do business in India and be profitable, then a lot of players who are waiting in the wings can also join into the scheme. While Pranjul is making a very valid point that the extent of subsidy is still very limited. It's less than 1% of GDP by our current GDP standards. The critical thing is that the sectors on which PLI is there is also less than 1% of GDP. So even if that less than 1% of GDP grows at a very fast pace, that's not going to move the overall GDP growth needle. So either we have to think of this as an experiment which brings in more investment in other non-PLI sectors, or we will have to expand PLI to a vast many sectors for us to see the whole macro impact of PLI. Otherwise, what's going to happen is that this year we will be discussing PLI. Next year when you are going to call me, you are going to find another acronym, and we will keep on discussing that acronym without having the continuity that we require.
Now, Soumya Kanti Ghosh, you're very bullish on some of the policy moves that the Modi government has made and their potential impact on Indian economic growth. But like we were hearing in the conversation with market experts before this, the fact that this is India's moment is not being said for the first time. Now, this is something that's been said multiple times in multiple years gone by. And therefore, what makes you confident that this is truly India's moment? Because in the past, we've had the knack of finding some way of snatching defeat from the jaws of victory, or not being able to capitalize on the moment like we should.
Thank you, Rahul. I think I will just very quickly quote some data points to support the point that Indian economy is actually placed in a sweet spot. The first is that look into the banking sectors. The net NPA is now at 10-year low. Credit growth is at 10-year high. Look into the digitization. The total number of UPI transactions this year is already touching 100 trillion. That could actually go up to 130 to 35 trillion at this date, which could be 45% of India's GDP in the current year. Look into the SME sector. The overall credit growth in the current year, 10% is being contributed by the SME sector, and there is now clear evidence that a part of the SME sector is actually getting bigger. That means they are moving up the value chain. Then there is the look into the external sector, export data. Even if last year we did 420 billion, at the current rate we could actually do around 450 billion. This is apart from the services data. Tax to GDP ratio this year could be at the highest level, and India is the only country which has increased and seen an improvement in the tax GDP ratio. So there is compelling evidence of the data supporting that we are in a sweet spot. But the fact is that we need to take advantage of that. In the past also we had done, even in the external sector, we have already recouped more than 50% of the foreign exchange reserves, which was at the lowest level at the end of October. So in rupee, in real terms, it is actually appreciated if you look into the BSI data. So household debt to GDP ratio, look into the latest BSI data, it has actually now declined from the peak in March 2022. So on all counts, we are in a sweet spot. The point is, where do we grow from here?
Okay, so let's come to that, because we saw recently the World Bank enhance India's growth forecast from 6.8% to 7% for this fiscal. I'll start by asking Pranjal first for her broad sense for how the Indian economy is likely to grow next year.
Yeah, I think next year is going to be a bit turbulent and growth is going to slow down for a couple of reasons. One is global trade is slowing. You mentioned that a lot of people are not expecting a hard landing, but it's still slowing across the world. We can see trade volumes that we track very easily slowing. So exports will slow, and exports are important because they were a big driver of our growth when we bounced back from the pandemic. Then if you look at our consumers, a lot of the pent-up demand after the pandemic is now done. If you look at the deposits at bank, they are back to pre-pandemic levels. And then you have a government which is trying to bring down the fiscal deficit. Fiscal consolidation in the short run can take away from growth. So I think for all of these reasons, we will see growth softening in 2023. But we should not worry about it. We should focus about macro stability, keeping inflation low, bringing down fiscal deficit. Because once the global cycle turns, I think India today is really geared for a takeoff. And I would agree with Soumyakanti Ghosh on many of these points he's made. I think there are two very exciting sectors: high-skill exports, where India is doing well, and then the entire tech startups. I know it's slowing a little bit right now, but this consolidation is good. I think in the medium term, our tech startups can find a lot of digital answers to real-world economy problems.
At this moment, what's your estimate for growth for next year?
For next year, we have growth at about 5.5%. But after that, we have growth going back to 6% plus.
At this moment, you have no intention of revising upwards the growth figures from what you did previously.
Yeah.
Okay,
Yeah.
Samira, how do you see India's growth outlook for next year?
So it's, as Pranjal was mentioning, that there are some headwinds to deal with. But the way I generally want to look at this number is that if you look at last 2 decades, on an average, consumption has always contributed about 400 basis points to GDP growth, at about 4%, becomes like a absolute bottom for us. And on top of it, if we get just about 7% investment growth, we are at 6% overall GDP growth. So I think 6% kind of becomes a number which is quite achievable. On top of it...
So you're slightly more bullish than Pranjal is?
Yes, I am. I think that the current data is not supporting a slowing economy. So there is right now a big disconnect between the data and the narrative. The narrative is more negative, as some of the things that got discussed earlier about headwinds coming from global slowdown, headwinds coming from fiscal contraction, monetary tightening. But you look across all high-frequency data, there is barely any slowdown in that. We are still running at a rate which is almost pre-COVID growth. So I think I will be slightly more optimistic on achieving a growth number of closer to 6 next year. But obviously global headwinds can change.
So we are getting more optimistic as we go from right to left, from 5.5 to 6. Soumyakanti Ghosh, are you taking the needle up even further?
No, I think I would tend to agree with Samira's point. We are a little higher than 6%. I think one possible advantage next year is that prices will actually be rapidly cooling off. So, I mean, for example, oil prices. Also, the fact is that the globally, domestically, I think inflation possibly has seen the worst, the peak, and inflation will progressively come down next year. food prices has been surprisingly, even after such an bad weather in the last 3 months, I think unseasonal rains, food prices have behaved remarkably well. And with a 46% weightage in the overall CPI basket, if inflation behaves well, which is doing right now, and actually it has surprised a lot of the market expectations and forecasts. I think the stage could be set for an positive GDP surprise next year, because all GDP numbers last year, I think there is a disconnect between the leading indicators and the GDP. Last quarter GDP, the forecast which the NSO gives out 7%, I think that was nobody was expecting. So I think that next year we could see a positive surprise on a back of a relatively stable macro environment where inflation will not be an evil as we have seen this year.
Now, one of the reasons why so many global companies are bullish on India at this moment is also because what's happening in China. But on China, opinion is divided. Pranjal, the one sense is that China's decline in terms of economic growth is now permanent. The number of old people is growing up, the youthful population, working age population coming down, and therefore this idea that companies will look beyond China on the back of the pandemic, on the back of growing trade tensions between China and the United States is now inevitably going to help India. The other thought is that some of the obituaries about China's growth have been written in the past wrongly so, and China is a story which global leaders like to kick down. Look at the manner in which the economy is reopened after all the COVID cases and the deaths stabilize, and because Xi Jinping seems to be showing greater moderation and more pragmatism, China may not be as badly written off as many pundits would like to believe. Where do you see China go next?
Well, look, I just want to make one point here. What we find in China right now is that they are sitting on about $1 trillion of excess savings of households who were in lockdown for 3 years. And as they gear to spend, that will provide some stabilization to global growth. When you made the point that we will not have the hard landing, I think a lot of that will come because now China is reopening and Chinese households and consumers are ready to spend, are ready to travel. So from that perspective, you can't completely write off, a very large economy like China. There are global value chains that are rejigging across the world for various reasons. A lot of people talk about deglobalization in growth, and maybe there are in goods, and maybe there are not too many opportunities there. But I think where India has a big opportunity in front of it is a continuing globalization in services. I think, we stand in a very unique position. We've been there from the knowledge processing center days to now the GCC, Global Capability Center days, when a lot of large multinationals want to put a lot of their research and back-end work in, places like India. And I think we really stand to gain on that part of the global rejigging of supply chains.
Samir, now two things could happen in China. One, because of pent-up demand on account of the economy and the country being shut for 3 years, China is bouncing back, but this is temporary. It kind of falls to a new level, which becomes the new normal for China. The other is that don't get pessimistic on China just yet, because it could bounce back and stay high. What do you think will happen next?
So Rahul, very interestingly, if you look at the IMF forecast for India and China growth, what strikes is that over the next 5 years, India's GDP growth is going to exceed Chinese growth. And that's going to happen first time after 1960s. For 1970s, 80s, 90s, 2010, 2020, 50 years, India's growth has always been lower than China. I think that way, it's a unique opportunity for India. But if I answer your question more directly, there are two things going on in China. One is the reopening trade. The other is the real estate trade. And both things can have very different implications for India. I think the reopening trade, the $1 trillion excess savings that Pranjal was referring to, is going to be spent more on services. That's not going to cause much challenge for India. It's the real estate trade. If the Chinese real estate now starts picking up, that's going to create the next commodity price cycle. And that can destabilize the point that Shoma was mentioning about low inflation in India for 2023 being a tailwind for us, that theory can get questioned. And the last issue is that to what extent this China reopening would lead to a reallocation of capital flows in the EM space. We are already seeing that in the first few days of the year, money has flown or got reallocated from India to China. The Chinese market valuations are much more attractive at this moment than the Indian valuations. So if this continues, then that can become some sort of a headwind. So commodity price effect and the capital flow effect are the two things that I will have to watch out for.
Soumya Kanti Ghosh, a lot of the current economic narrative around China was built at a time when the economy was shut. Xi Jinping acting as the ultimate emperor, taking impractical, irrational decisions that seemed to be damaging the economy. The last few weeks, though, at great cost to Chinese health infrastructure, has suggested much greater pragmatism. Does that then mean that a lot of the benefit that a country like India would have been hoping to get out of China's economic slowdown now just stays hawa mein and doesn't actually materialize on the ground?
I think that's an interesting point. But before that, let me just give you one data which Shamiran talked. I think in terms of the stock market resilience, India's the market capitalization is increased in dollar terms 2.3 times than what it was in March 2020. So that's one of the impact of this China. Now, specifically in terms of China, I just want to play a devil's advocate over here. I think China, it's always difficult to believe the data. So, I mean, yesterday there were some numbers which are saying that 80% or 90% of the population is already going to get infected. And please note that China doesn't have an effective vaccination strategy for its population, which India actually had, and India was able to quickly ramp up the vaccination for its population and in a war mode. So with the country and given the type of disease it is, I mean the COVID, I think without an effective vaccination strategy, China may be reopening, China may actually, there could be some reallocation of capital. But over a point of time, I think India will stand at a far better advantage because after
once China reopens, and let's assume that 80% of the population has been infected, whoever is vulnerable and susceptible suffers the consequences, a lot of people even die. But then the economy is open and people have immunity. So they can get back to business as earlier.
Yes, but that will take time. For India also, we saw that vaccination strategy played out over a point of time. From May 2020, when we started to vaccinate the people, we were able to vaccinate a large part of the population in 2022 beginning. So if I go by that trend only, with the same population of China and India at this point of time, I think it will take a larger time to vaccinate this entire population. Till that point of time, we can enjoy the tailwinds of the global economy. But of course, as China opens up gradually towards the end of the year, it could be an competition between the two.
In the few minutes that I have left, I want to spend time talking about the outlook for GST collections. We've seen GST collections on a monthly basis hover in the range of about 1.5 lakh crore rupees. Is that, Pranjal, where you see GST collections stay next year? Do you see a potential for a moderate to high increase, or do you actually see them come down on a monthly average basis?
Well, it should rise in line with nominal GDP growth. But if you want it to rise even more sharply, like we saw over the last year, I think we need continued reforms in GST. We need to get more items into the GST umbrella. We need to talk about lesser number of slabs, more uniform rates. I think we need more reforms on GST if we want continued improvement.
Which of course every economist and right-thinking person would want. But Sameeran, are you concerned that given the practical reality of this being a general election year, that any reform, whether it is on the GST side, whether it is on tax, or whether it is in terms of pushing through hard disinvestment, will actually now only be seriously considered after the 2024 general elections? Or do you think that the government could potentially surprise?
So just a quick point on GST is that this is a peculiar year where for the first time, the central government will be collecting 1.4 lakh crores of GST compensation cess, but will not have to share it with the state governments. So that's going to make the fiscal arithmetic look much easier for the central government. But on the reforms question, I think where I started from is where I want to end with. Public capex is one area which I call reforms, which will have no political ramifications. So it's the easiest one to push even in a pre-election year. If you look at other reforms that economists typically talk about, there are winners and losers in those reforms. And typically every finance minister will be very considerate about implementing those reforms in a pre-election year. So I'm not penciling in too many of those reforms for this year, but public capex push is something which everyone likes, affects everyone positively, so why not do it?
Soumyakanti Ghosh, are you surprised with the government's approach on disinvestment? Arguably the most vexatious PSU to disinvest was Air India, which got pushed through with a lot of determination, and a lot of other strategic disinvestments, which should arguably have been easier to find a way to push through, have somehow not been done. And are you fearful that given the fact that we have an election, that a lot of this could be pushed out till after the next general elections?
Yeah, I think the answer is both yes and no. In terms of the disinvestment, I believe that more could have been done. But on
this is what economists love to do. They like to give answers which have both yes and no, and everybody else, like normal citizens, wondering, did he mean the yes more than, or did he mean the no more?
I'll explain that. But the good thing is that the government has been able to compensate the decline in disinvestment revenue through a surge in the tax collections. The tax buoyancy ratio, which is historically at 1.1, means that has been much higher in the last 3 years. So whatever has been the shortfall in the non-tax revenue has been compensated by the tax revenue, and that is because of the efforts that the government has been doing. So in my sense, yes, there could be a shortfall in disinvestment, or may not be that to the extent which we could anticipate. But my sense is that a large part of that will be offset by a buoyancy in the tax revenue.
Now you have to explain the yes and no on disinvestment. It can either be a yes, that they will push through on disinvestment despite it being a general election year, or it can be a no, they're more likely to push it out till after the next elections and not take any panga at this moment.
I think in terms of the disinvestment, some of this is very politically sensitive. Also in terms of the privatization, I think maybe that may not be touched this year. Maybe that could be pushed next year. But there is always this helping hand in terms of the tax buoyancy.
This was an interesting conversation. I want to thank Pranjal, Samiran and Soumyakanti Ghosh for joining us at the Business Today Market Today Summit and sharing your thoughts on India's economic outlook. Thank you so much. Thank you.
I suspect the market will not do much in the first half. That's how I would look at it. And hopefully the second half, as valuation becomes slightly more reasonable based on roll forward of earnings, hopefully maybe the market start performing. So let me just elaborate a little bit. So if you look at currently where we are in terms of the growth part, it's a mixed picture as far as the economy is concerned. We are seeing maybe some pickup as far as the basic or staples consumption is concerned, but clearly seeing a big slowdown on the discretionary part of the reason for that, which we can talk about later. If you look at the investment part, again, a mixed picture in the sense, housing is doing very well. That is the household part. Private sector capex, bits and pieces, things are picking up, but I think the big pickup should only happen from next year, looks like to me. And government capex, will be under through linked to the government's fiscal capacity to spend. So mixed picture, I would say, in the sense, we will do about 5.5% GDP growth for FY24, which is quite decent in the global context. If you look at on the interest rate inflation part, again, we are in a situation where I don't see major headwinds or tailwinds to the market from interest rates. In the sense, inflation has peaked both globally and in India. I don't see any necessity for the RBI to be raising rates meaningfully from where we are, and essentially inflation will decline quite sharply going forward. Having said that, core inflation is still sticky, and it is sticky everywhere in the world, which means the central banks will not be in a big hurry to cut rates also at the same time. So I don't see any, great positive or negative news from the interest rate part also. So I suspect given where we are on the growth part, where we are on the interest rate cycle, looks like we just meander through for the first half. And of course, valuations are still punchy as far as India is concerned. So yeah, so my hope is, probably you see some time correction, and the market already has seen a fair bit of time correction. If you look at the last 12, 15 months, the market hasn't really done much. So I suspect probably the same pattern repeat for the first 6 months. After that, we'll see, depending on how things pan out, and hopefully valuations start looking a bit more reasonable, as I was saying, based on all forward earnings. Hopefully the market starts performing on an absolute basis then.
Make your media plan smarter with India Today Live TV on your connected devices. Amplify your brand with 100 million smart internet viewers. To advertise, mail us at sales@aajtak.com.
Through the day, you've heard lots of things about the macro and all of that, but this is what you've come to hear, how you make money and how you beat the market. Three very experienced practitioners of all that with me. I don't need to introduce them. Ramdev, Shankar and Nikhil, all of them you know very well. Nikhil's the youngest, but he's been remarkably successful with Zerodha over the last few years. So my hat's off to him for what he and his brother have achieved over the last few years. He's also the most handsome man on stage of all of us, by quite a distance, though Shankar would dispute that. But Shankar, what's going on? In the last year, 60-70% of the PMSs and the mutual funds who investors pay 2-3% a year to manage their money have underperformed the Nifty. When you ask them what's going on, sometimes they say, last year they said because it was commodity stocks and we don't own commodities. This year they're saying because there were those rubbish PSUs and we don't own them naturally. What's the right way to look at it? I mean, it's only when their blue chip HDFC Bank does well, they are expected to beat the market? How do you explain this kind of underperformance? The lack of alpha?
Yeah, so last 12 months, I think it was Adani Group which was the problem area.
Nobody had them.
Nobody had them. And to be fair, I mean, let's be fair that fundamentally a lot of the stocks that did well, particularly this group, could not be justifiably held in a fund structure. You could hold it in your personal investing because, it's okay when then they go up 10 times or maybe 20 times. But there is no real, if you say fundamental on the ground reality because of which these valuations were deserved. I'm not disputing that figure is incorrect. All I'm saying is justifying that for a fund manager to his shareholders, to his investors, to the unit holders, to the regulator, if something were to go wrong, becomes a major problem. So you cannot play every game that is being played in the markets. It's not possible. So to be fair, the underperformance has come because of this one major factor. The Nifty has done better because of this. If you look at the difference between the Nifty and the small cap, that itself is telling you a lot of things. That small cap on an index level has not done as well. So, but the fact is there will be something that will do very well. People are underinvested. And the law of the market is very simple, that the money gets made where people are are least invested. And there is no real reason why you should be investing in the least invested. But usually that's the place where you end up making most of the money. Okay. And unfortunately, the incentive structure for a fund manager is geared towards retention of assets and hopefully some growth. It is not really a structure in which you're being paid to take a fair amount of risk. And that stems from the investors into fund or PMSs. And I can tell you, I've run these structures, and investors are the worst enemies, I can tell you this, because what they want is an impossible set of combinations. They want you to beat the market, they don't want you to lose money when the market falls, all in the same stock or the same group of stocks. That's not possible. These are impossible objectives to manage at the very same point in time. It's not going to happen. Right. And which is why you will find an odd fund which took the bet, let's say on Adani or in commodities. They will beat the daylights out of the market for a year. Okay, whether they'll repeat it or not, who knows. So the short answer to your question, Udayan, is that it's been a very tough environment in an organized form of fund management. Very, very, very tough. The headline index is not telling you what the underlying trade change has been. HDFC banks or levers or Asian Paints, they have been dogs. While the underdogs have become the big dogs. Welcome to the markets.
Yeah. Ramdev, what about this trend of public sector stocks, which did very well? And many fund managers traditionally have not owned these names, the Coal Indias, the Power Grids, NTPCs. What do you do as a fund manager when you see these kind of stocks coming back and beating the daylights of your core blue chip holdings?
So it's a problem in the sense that the markets are markets and...
Is your mic working?
Yeah.
Yes. You have to hold it closer.
Yeah. So markets are markets, and they will go... Like, one of the things which is happening is that because of sustained fall in the interest rate for last 10, 12 years, there was a method of madness in the sense that all kinds of growth story, whether it is profit making or not profit making, they were going through the roof. Just 12 months back, we were talking about Zomato and Nykaa and all. Today we are talking about public sector bank. Just see the contrast. What do you expect? Fund manager cannot move 1 lakh crore from, I'm not saying that Zomato and Nykaa, but say from Avenue Supermart or Asian Paints and all those bluest of blue chips to, some public sector banks and all. That's not the mandate. I would say that it is impossible to do it. So, but that's what market has done. So I think there is somewhere very deep, I'm all the way growth investor, good time, bad time, but clearly somewhere value is asserting. There is a very strong value rally right now. Maybe it was overdone on growth side, and even the decline in the interest rate was also overdone. So, like whatever the pendulum is swinging from that 18%, 10 year in 81, 82 to literally zero to now maybe 3-4%, but definitely not minus 20. So from 0 to maybe 3-4%, 5%. So there is a clearly change of cycle there, and we are still struggling with accepting it. What has happened. But even now, today, the same companies are still cheaper than your growth companies.
True. Nikhil, is it driving local investors?
To add here, sure. As a follow-up answer to your question, Udayan. In the 90s, most of us were born in the 90s in this business. And a lot of the mutual fund managers who have great 25-year records, who became CIOs and then some of them retired. I can tell you one thing. A lot of the performance actually stemmed from 4 or 5 years of from 95 up until 2000. And I'll tell you why. I'm talking the index beating. Because the tech sector, the TMT sector, okay, Infosys, Wipro, Z and all that, they did not have any participation in the Sensex. Okay, so the Sensex actually did nothing between 96 and 2000. If anything, it was probably down a bit. But everybody had tech. And they beat the daylights out of the index. Okay, they beat it by like 10-20% points every year. Now that put performance points into your bank, which you ate off for the remainder of your career for 20 years. So you cannot complain that, look, the market is moving in a direction where I am underinvested, because you were in a underinvested area which was not in the index, that did phenomenally well, beat the market. The market did not have those stocks in the index. So, the market cuts both ways. I mean, so we cannot really complain. I'm just pointing out historical facts so that we understand that the markets usually are a tricky place to be in, and we can't just make 1% for doing nothing.
True. Nikhil, is it driving a class of local investors towards passive investing? Because they look at the index and say, I pay 0.2%, just buy the index. And that's good enough from these fancy investors you pay so much money for to manage my money. Is that a fair point, or do you think active investment will actually beat passive investors in the medium term?
So, Udyan, it's a tough answer because we have an active management fund.
I know.
As well. If you look at it historically, I think passive has done better. That 1-2% a year, if you were to compound that over 20 years, mathematically, I think it is quite hard for an active fund to beat a passive fund. And
even in India, people think it's in the US. In India, it'll be different.
Well, if somebody is charging 2% every year for 20 years, that's a significant portion of your corpus. That being said, I think active does better in flat markets or range-bound markets, and passive probably does better in trending markets. Considering how expensive the markets are today relative to the rest of the world, maybe there is a case to be made why active could do better in the next 2 or 3 years when Nifty doesn't give stellar returns. But over a long term, I think passive will continue to outperform because our fee structures are not efficient enough. I don't think anybody can really bring in alpha for a client charging 2%, having a distributor in the beginning who charges a fee and an exit load and all of that. I think it will be quite hard in that model for active to actually outperform.
That's remarkably candid of you to say it because you are in that game yourself. Are you doing something to disrupt that or change that?
Well, I would say we are trying, but I don't think we're doing anything significantly different to warrant a change to kind of, weigh the scale more towards the active narrative. We are charging much lesser and stuff like that, but I don't think that one thing is enough because we're still charging maybe 10% of carry, and to get that much alpha is quite hard over the long term.
Shankar.
I'll tell you one simple golden formula to beat the market as an active fund manager, okay? And that is if you get the bear market right. Because your biggest alpha will come when the market falls 40 and you're falling only 20 or 10. In a bull market, you will not be able to beat the index. Impossible. And therefore, if you have the skills to get a bear market right, and you fall half the market, you fall 25% of the market, you have put 20% point in the bag, and then you will gradually fritter it away over a 3-4 year period to still end up ahead in the game. And which is why it's an underappreciated skill to get the bear market right. Okay? And bull market, ultimately bull market, most people will have similar stocks. It's very hard to be away from, the consensus trade. So therefore, the skill where you can add value as an active manager is to get the bear market right. And occasionally, if you get that right, and I think every 3-4 years you will get a down year, just make sure you get that part right.
When is the next bear market according to you, Shankar?
I don't think it's happening anytime soon, which is a problem for active managers. Okay, it happened, 2 years back, in COVID. Now, if you were alert enough, you could have seen that. I mean, it was not difficult to spot that there was some degree of fall coming, not a bear market, maybe not a huge bear market, but I think from February 2020, there was enough data and the screen was telling you from Japan up until Italy, schools are closing down and everything. I mean, that was not like a SARS virus. It was very clear this was a catastrophe, a calamity, and they would have some impact. So if you positioned yourself through some hedges or if you could short in your structure, I think you would have made significant alpha right there. In a month, you could have been up 20% relative to the market if you were smart enough to do that.
Lovely hearing your thoughts, gentlemen, and to see you in the flesh after a long time. Thank you very much, all of you. Pleasure.
congratulations on this good set of numbers that you've reported. Your own take, was it in line with your expectations or better than your expectations? And also, what were the key factors that really supported the bottom line?
As you know, we were the first ones in the life insurance space to do a M&A, and we had guided the street that we will be margin neutral about a year down the line. But very happy to share that we are already at margin neutrality, which means that the combined entities' margins, new business margins, are in line with where we were last year, and from here on, we will continue to build that upwards. So slightly ahead. Apart from that, very happy in terms of whether it's in top line. We have grown faster than the sector at 17%. And all the elements of growth, our agency channel, their share has grown from about 14% to 18%. Annuity has trended upwards about 60%. Protection sequential growth has been about 13-14%. Credit life has grown upwards of 50%. And hence, because of all of this, this has not surprisingly resulted in fairly healthy margins and also a healthy PAT, like you mentioned, of over 15% growth.
What are the trends that you're already witnessing? 20th of January already here, in January, and for the entire FY23, can we safely say it's going to be a good growth year for HDFC Life?
Yes, it's going to be a holistic year. Good growth in profitability, very steady in terms of quality of business, in terms of persistency.
Snakes in the backyard sting Pakistan. After economic crisis, Islamabad faces security challenges. The Tehreek-e-Taliban Pakistan's return to acts of terror, extortion and hostage-taking is turning the clock back for Pakistan by a decade. On 2nd January, there was an angry exchange of words, indicative of how placing Taliban in power in Kabul has gone wrong for those at the wheel in Pakistan. Pakistan's Interior Minister Rana Sanaullah spoke about attacking Tehreek-e-Taliban hideouts in Afghanistan. In reaction, Ahmad Yasir, a Taliban leader, put out an image of Pakistan's defeat at India's hands in 1971, warning Islamabad of a repeat if Pakistan attacks Afghanistan. Pakistan Defence Minister has alleged that Afghanistan's soil is being used by armed groups to launch attacks, triggering a sharp response from the Taliban government to call the charge incorrect. The Tehreek-e-Taliban has issued threats to the Shehbaz Sharif government, accusing it working for the Americans. It has asked PM Shehbaz Sharif and Foreign Minister Bilawal Bhutto to review their policy against them. Ever since the Taliban got a hold on Afghanistan, Pakistan has witnessed a sharp rise in terrorism incidents. TTP was involved in 2007 assassination of Benazir Bhutto, 2009 attack on Pakistan Army headquarters, 2008 bombing Marriott Hotel in Islamabad, 2012 attack on Nobel laureate Malaya Yousafzai, 2014 attack on Peshawar school. Pakistan, which nurtured the Tehreek-e-Taliban Pakistan to use it as proxy force in Afghanistan and India, is now getting a taste of its own medicine. Bureau Report, India Today.
Mr. Shadan Farasat, the government's view is, look, the Supreme Court has cleared the Prime Minister. The Prime Minister has been cleared of any... Then a documentary comes which suggests that maybe there was involvement of the government. There's a huge question mark over that 27th February meeting where allegedly the government said that the police should not interfere when rioters are on the street. There is no evidence that such a meeting took place. That evidence has been dismissed in a court of law by an SIT. Why should the government of India therefore not respond strongly is the argument that Mr. Modi's supporters make.
See, I have had an opportunity to look at a documentary. I have seen the first part. I think one can have two views on whether you agree with it or not, but I personally didn't find anything which, you need to ban as such. And, the issue of Mr. Modi's role has been in the Indian politics for 20 years. So surely I'm a little actually surprised, even from a perspective of self-interest, why would a government do that? Because it only attracts more eyeballs to the issue. The more you ban, the more people are inquisitive, oh, what does it have, right? So that's number one. But I want to make a larger point about this. I think the challenge today, the government has used the emergency powers under the IT rules of 2021. I think it's very important to understand that government should never have the power to regulate or censor something. Be it the Press Council of India in the context of the textual press, or be it the censor board in the context of cinematographic.
But that's wishful thinking, Shadan. From the time of Indira Gandhi, and we can even go back earlier to Nehru, from time to time, governments do not like to be put under the have resorted to censorship. It's not something that started in 2014. You have state governments like Mamata Banerjee's who arrest a professor for a Facebook post.
I take your point fully, Rajdeep. I am in agreement with you that this is not just, specific to a political party. It's happened across the board. It happens even today. The point I'm making is this. I think it's important that there are independent, genuinely independent regulators for these kind of things. You can't leave these powers with the government, because what happens then is obviously the kind of bans we are seeing now. And just give one example. BBC has done this documentary. Possibly it does not even suit Rishi Sunak today. I mean, obviously we are engaged, Britain and India are in a negotiation over FTA. I'm sure Rishi Sunak, it's not in his interest to have this documentary come out. But because BBC is an independent broadcaster, right, it is capable of doing it. That's independence for you. So what we need is here independent regulations so that these kind of bans can't be done by the government. You need something genuinely independent. I